In its financial stability report for December 2019, the Reserve Bank of India has made a very interesting note about the solvency risk posed by non-banking financial companies and housing finance companies to the wider financial system. Given that NBFCs and HFCs compose the two largest borrowers from the financial system, any risk of failure of an NBFC or HFC could lead to solvency issues and a failure of a bank or other financial entities. In its June 2019 report, the RBI noted that a failure of an NBFC or HFC could lead to a failure of a bank. But in the December 2019 report, the RBI has taken away this projection by saying that a failure of an NBFC or HFC today would not lead to a bank failure. In fact, as per the financial stability report, the RBI has said that the failure of an NBFC in June 2019 would lead to a 2.7% erosion in the Tier 1 capital of the banking system, and a failure of a housing finance company could lead to a 5.8% erosion in the Tier 1 capital of the banking system. The RBI, 6 months later, in its December 2019 report, has revised its outlook and said that a failure of an NBFC would instead lead to an erosion of 2.5% of the bank's Tier 1 capital, whereas a failure of an HFC would lead to an erosion of 4.6% of the banking system's Tier 1 capital. Essentially, what this means is that the contagion risk that an NBFC or HFC failure could lead to a solvency risk to a bank or other financial entities has since reduced. This is mainly on account of NBFCs and HFCs over the last year and a half improving their borrowing strategy by moving towards longer-term loans and longer-term debt and away from short-term paper. By shifting their borrowing strategy to longer-term debt from shorter-term debt, the risk of a failure of an NBFC or HFC is therefore reduced, and therefore a failure of an NBFC or HFC to the wider financial system has reduced according to the RBI's report.